All right, let's get right into it. Welcome to the StoxCompare Explainer. Today, we're unpacking one of the most fascinating and honestly polarizing stories in the semiconductor market right now. We're talking about Microchip Technology, trading under the ticker MCHP. Now, if you've been watching the tech sector over the past few years, you know that chip stocks have been the absolute undisputed darlings of the market. But Microchip? Well, they have a completely different story. We're going to dig into the hard data to figure out if their current cyclical trough is a dangerous value trap that you need to avoid, or if this is actually a generational buying opportunity just hiding in plain sight. We've got a lot of ground to cover, and the numbers are going to tell us exactly what's going on under the hood. First off, the sheer magnitude of this 5-year disconnect is staggering. While the broader AI chip sector, your NVIDIAs, Broadcoms, and AMDs, have gone absolutely parabolic riding the generative AI boom, Microchip Technology has essentially flatlined. Over a 5-year period, we're looking at a measly positive 7.39% return, closing out right around $81.39. In the semiconductor world over the last half-decade, a 7% return feels like going backward. So, the immediate question this forces us to ask is this the market's most mispriced value play, just waiting like a coiled spring to catch up? Or is this company permanently left behind, fundamentally broken while the rest of the industry evolves? To answer that, we first have to recognize that not all chips are created equal. Microchip completely missed the generative AI hype train. But actually, scratch that. It's not because of a failure in their business model. It's because they operate in a fundamentally different economic cycle. On one side, you have the immense hype, the massive GPUs powering large language models and huge data centers. But Microchip's reality is entirely different. They make microcontrollers, or MCUs. These are sticky, essential, analog, and mixed-signal chips. We're talking about the unsung heroes of the physical world. These are the chips that control automotive and EV braking systems, industrial robotics, smart appliances, aerospace, you name it. They don't do the glamorous AI math, but the modern physical world simply cannot function without them. So if their products are so absolutely essential, why is the stock struggling so much? It boils down to a textbook inventory digestion cycle. I call it the whiplash. During the pandemic era supply chain panic, Microchip's clients were literally terrified of running out of parts, so they aggressively double-ordered. They hoarded inventory. This sheer panic drove Microchip's revenue to a staggering peak of $8.44 billion in 2023. But once the global supply normalized, those same customers looked at their packed warehouses and just stopped ordering. They had to burn through all that excess stock first. As a result, Microchip's revenue is estimated to plummet to just $4.40 billion in 2025. They essentially saw their revenue cut in half in just 24 months. And when revenue gets sliced in half in a heavy manufacturing business, things get ugly really quickly. Fixed costs bite back hard. Semiconductor fabrication plants have massive, immovable fixed costs. Whether you're running that factory at 90% capacity or 40% capacity, you still have to pay for the massive facility, the ultra-expensive machinery, and your core staff. So, when client orders fall off a cliff, low factory utilization absolutely destroys your margins. We're talking gross margins compressing from 67.5% in 2023 down to 56.1% in 2025. But the real pain, that's in the operating margins. Operating leverage works in reverse here, cratering operating profitability from a very healthy 36.93% all the way down to a mere 6.73%. When you translate those shrinking margins directly to the bottom line, it reveals a pretty breathtaking cascade. Back in 2023, Microchip generated $2.24 billion in net income, with a stellar net margin of over 26.5%. But as that inventory glut wiped out demand, we saw a brutal cascade of operating leverage losses and inventory write-downs. By 2025, they're projected to hit a net loss of negative $0.0005 billion. Think about that. They've gone from record multi-billion-dollar profitability to literal break-even, a net margin dropping from 26.5% to practically zero at negative 0.01% in just 2 years. If you're just screening for short-term earnings, these metrics alone would probably make you run for the hills. But hold on, because right here is where the narrative shifts. While the income statement currently looks like a disaster zone, the balance sheet reveals an absolute masterclass in management de-risking. Instead of panicking or making foolish overpriced acquisitions during the 2023 cyclical downturn, management ruthlessly deployed their boomier cash to fortify the castle.
Their debt reduction is a prime example of this. They took total debt from $8.90 billion in 2021 and steadily chopped it down to $5.63 billion by 2025. Shaving $3.2 billion off your debt load pulls the debt-to-equity ratio down significantly. This is exactly the kind of defensive capital allocation you want to see from a management team trying to navigate a severe cyclical trough.
So, how exactly did they do it while profits were collapsing? Through some brutal financial discipline to preserve cash. Cash from operations dropped from $3.62 billion in 2023 to under $1 billion in 2025. To keep that free cash flow positive, management aggressively tightened the CapEx valve. They slashed physical factory capital expenditures from $0.486 billion down to just $0.126 billion. By cutting non-essential factory spending absolutely to the bone, they still managed to squeeze out $0.772 billion in positive free cash flow during the absolute worst year of the economic cycle.
Now that tight cash flow brings us to a massive, glaring red flag that every single investor needs to be aware of. Is the dividend safe? Microchip has a strong historical commitment to returning cash to shareholders through dividends and buybacks, but right now, that commitment is violently outpacing their trough earnings. As we just went over, they're generating $0.772 billion in free cash flow. Yet their total capital return to shareholders sits at $1.01 billion. That creates a mathematically dangerous 126.37% payout ratio. You definitely don't need a math degree to see that paying out more cash than you bring in is completely unsustainable over the long term. Management is effectively betting the house on a swift cyclical turnaround because otherwise, that dividend is absolutely going to be on the chopping block.
But here's a strategic nuance that makes this company so compelling to look at right now. Even while they were aggressively slashing factory capex to save the dividend and pay down debt, management firmly refused to gut their innovation engine. This is all about funding the future. Their research and development expenses prove this point beautifully. Despite the massive revenue crash, R&D spend has remained incredibly sticky, sitting right at nearly $1 billion, specifically $0.984 billion in 2025. And because revenue dropped so sharply, R&D now makes up a massive 22.35% of their total revenue. That's up from just 13% 2 years ago. Why? Because they are quietly preparing their product pipeline for the coming wave of edge AI and increasingly smart, connected embedded systems. They're willingly sacrificing short-term margins to ensure they aren't left behind in the next decade's tech cycle.
So what does this all mean for valuation? How is Wall Street pricing this? We're looking at a classic dilemma here. Are we pricing the bottom? Is this stock historically cheap, or is it rightfully discounted? The market right now is pricing Microchip as if this bottom of the inventory cycle is permanent. Valuation multiples have been absolutely crushed. Their price-to-book ratio has literally been sliced in half over the last 5 years, dropping from 7.83x in 2021 down to 3.68x today. Yet, simultaneously, because of that aggressive debt paydown we talked about earlier, the company is sitting on a hyper-safe working capital ratio of 2.59. They have plenty of short-term liquidity to weather this storm. For patient capital willing to look past the current quarter's messy earnings, this creates a massive valuation reset.
Which brings us to the ultimate verdict on Microchip Technology. Are we looking at a value trap or a coiled spring? Let's summarize the facts. The bear case, the value trap argument, is very real. We're looking at sluggish top-line growth in the near term, zero direct exposure to the highly lucrative AI and GPU hype, and severe dividend payout pressure sitting at over 126% of free cash flow. That is undeniable risk. But the bull case, the coiled spring, is equally compelling. The cyclical bottom and inventory digestion appears to have finally been reached. They've executed a massive structural debt reduction since 2021, drastically lowering their enterprise risk, and their high R&D commitment perfectly positions them for the upcoming edge AI revolution. Balancing all this data, our StoxCompare final rating is a hold, or more specifically, accumulate on weakness. It definitely requires patience, but if management can maintain that dividend through the trough, the structural improvements to their balance sheet might just make this stock a tightly coiled spring for the next macro upcycle. The question I'll leave you with today is this. In a market utterly obsessed with tomorrow's AI promises, are you willing to bet on the essential, heavily discounted plumbing of the physical world? Thanks for joining me on this explainer, and as always, keep doing your research.